Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. 16th of July, just after the close. Boom! That was a smack in the face from the Russell 2000 this week, wasn't it? A continuation of the trend we've really been talking about now for going on 5 weeks, 6 weeks, 7 weeks, late May. Large cap becoming the dominant class in equities, as we had seen the previous 6-7 years, with the exception of late 2020 into the first quarter of 2021. We liked that breadth that we were seeing out of the Russell 2000. We liked it. It was more sectors being involved, more industries being involved, value is being involved, but we've seen that reverse. Started slowly in May, continued in June, and really gained momentum here in July. Russell 2000 down 5% this week. That has a little whiff of panic to it. That's late money that got caught chasing that index, which, keep in mind, when we go back to April 1st, or through April, Russell 2000, small and mid-cap stocks were up 2x the S&P 500, almost 3x the NASDAQ 100. So at one point, the Russell was up 15% year to date, while the S&P was up 7%, 8%, and the NASDAQ 100 was up 4 or 5%. We close out today's week with the S&P up 15% year to date, NASDAQ up almost 14% year to date, and the Russell down below 10%. Again, a lot of wisdom in the market. We have to continue to look at those type indicators that we speak weekly about. Relative strength. When we see one asset class within the equity family start to put in serious strength against another, have to pay attention. So we did make some changes, as you know. We did lighten up significantly in value. We did lighten up significantly in our small cap area, in our U.S. ETF portfolio. We're sitting on about 13, 14% cash there. Currently, that's fine. What do we need to see, though, to put more cash to work, or, more importantly, to not raise more cash? What would get us a little more offensive? We need to see the broader market get sticky. Need to see small caps dig in a little bit here. Need to see mid caps dig in a little bit here. Need a bid out of the banks. Need a bid out of energy, which, after a heck of a run, down 7% this week. So we do have a little cash in the bucket. We will look at sectors. We will look at industries. As a matter of fact, we did add to semis this week into some of the pullback. That pullback certainly may not be done, but we do have cash to work with. In the tactical, same type thing in tactical trend. We have 8, 9, 10% cash. We will keep our eye on some strong sectors that are now showing some shorter term or intermediate term weakness. Keeping our eye on always on higher lows. Want to see those higher lows. So going into next week, we'd like to see a little bit of strength out of the cyclicals, out of your basic materials, out of financials, as I mentioned. Just to show us as investors and traders that we can still get some breath back in the market, and we don't have to concentrate on the narrow large cap tech area, which has held up relatively well so far, making new highs as recently as mid-afternoon yesterday. So we're in good shape in terms of the portfolios. We'll keep our eye on opportunities. Fixed income, we saw the 10-year retreat to about 130, something John will touch on and something we're watching day by day, as the interest rate market often is a barometer for what the economic expectations are 3, 6, 8, 10 months down the road. Have a great weekend. We'll see you next Friday.
Hi, it's John Mousseau. I am the Director of Fixed Income and CEO at Cumberland Advisors. It is Friday morning on July 16th. A bit of a puzzling week in bonds, for sure. When you think about what happened this week, pretty innocuous on the action, right? The 10-year bond down from 136 to 133, the 30-year bond down from basically 199 to 195, down 4. Short-term yields actually up a couple of ticks. Muni yields unchanged and had very good demand across the board. 10 and 30-year AAA munis were at 0.84 and 135 respectively. So not a whole lot of action. It's kind of the same old, same old. I said good demand for bonds, etc. The problem is when you actually look at the numbers that came out this week. So you look at, as you've heard us talk about, the monthly numbers on inflation, both CPI and PPI. We got them this week. We've been watching the monthly numbers, not caring about the yearly numbers as much. So the monthly numbers on CPI, 0.9 versus 0.5. PPI, 1% versus 0.6. Those are big jumps, well above expectations. If you want to look at the year-over-year numbers, they're 5.4 year-over-year on CPI and 7.3 on producer price indices. No question these numbers come down over time. Some of these monthly numbers come down over time. But across the board, everything's up, just a question of degree. So you want to talk about food, energy, transportation, used cars, they get a lot of press. All of that's up. Some of this does moderate over time. The real question for us at Cumberland is those run rates. Even though they'll moderate and these month-to-month numbers moderate, if we get out to, say, the fall and these numbers have come down, but the run rate is at 4 and 5%, it's very hard to justify a 10-year bond at a 135, right? So we do expect to see some movement up in yields as the year goes on. Some of the reasons why you've seen some of this decline in yields, partly summer doldrums, partly fear of the new Delta variant on COVID for sure, partly just some reversion of the mean given the fact that yields moved up from 0.5 last summer on the 10-year to 175 by the time you got towards the end of March. So, all of that probably figures into some of this. So, it's another reason why we have bond portfolios positioned defensively. We will continue in that mode. Certainly, when you look at some of the historical numbers on this, bond markets tend to be slow to react to things like inflation numbers because they are waiting to see whether they are indeed transitory or a little more permanent. Hope you have a great weekend. Thanks a lot.